this in conjunction with some of my colleagues at Cal State Long Beach, as well as with other parties, other groups throughout Southern California, trying to get a sense of, tracking where things have gone and trying to get a sense of where things will be going. So we don't have a lot of time, and there's an awful lot of material that we could talk about, but let's just focus on three main questions. What's happening now, and with that, in that regard, I'm referring to the last 2 or 3 months. What's the bigger picture? So I think it's important for us to bring some national and state scope into the picture, even though we really want to know what's happening with the local economy, and what's the outlook. And so you'll see that I spent a lot of time talking about labor market numbers and job numbers. That's mainly because the information that we have that is most current about the economy really comes from that segment of our database, so to speak. So I'll spend more time talking about that than some of the other indicators that you may be aware of and familiar with. But we'll touch on some of them. But the most important thing, I think, is to talk about what reopening the economy looks like. And everybody wants to know what letter will characterize the recovery of the economy. So let's get started. I think it makes sense, since we're talking about COVID, to take a look at the track record since early March. This is LA County's COVID cases, the new cases per day. And, one would think, based on the figure that we're looking at right now, that maybe we're going to see a gradual decline in cases, but let's keep in mind that as we open up more and more segments of the economy, we would expect to see that the number of cases on a daily basis will likely increase. So we'll come back to that in a few minutes, but that certainly is one of the concerns that I have about how the economy is going to fare in the coming weeks and months and quarters. Okay, so when we first began to track what was happening in the economy, it became evident that the unemployment rates that we typically look at to gauge how the labor market's doing just weren't satisfactory. The fact of the matter is that labor information comes out once a month. It's based on data that is compiled during the week of the 12th, so the week during which the 12th of the month occurs. And you'll recall that the shutdown in March occurred later on in that month. So what you see here are unemployment rates prior to the onset of the pandemic shutdown and what happened afterwards. So we already had certain segments of the economy that were adversely affected prior to the shutdown. Restaurants were already having to shut down. Arts and entertainment venues had closed. Conventions were not happening. Travel wasn't happening. Parts of transportation had pulled back. So we actually saw a number of areas where we were losing jobs even before the shutdown occurred. Then the shutdown occurred, I believe it was March 17th or 18th, that the governor announced a shutdown for the state of California. And so you would have expected perhaps that March would then show some real change. But keep in mind, as I said a minute ago, the March numbers really were based on the week prior to the stay-at-home mandate. So we didn't really see things until we get into the month of April. And that's where you see the spike in the unemployment rates for LA County, for Long Beach, for the state of California, and for the US. So a 20.6% unemployment rate for the city of Long Beach, basically 5 times what it was a month earlier. This is truly unprecedented. Same for the county and for the state and for the nation. Now you also see for the United States, we did get a May reading that showed a 13.3% unemployment rate. So that's down from the month of April. There was some fine print, if you will, in the report that the BLS produced that basically said that given certain considerations, it's very possible that the 13.3%, the official rate, is considerably lower than the actual rate for the month of May, that in fact the month of May probably saw a higher unemployment rate than what was reported, and perhaps there'll be some corrections forthcoming. Bottom line is that these are unprecedentedly high unemployment rates. We haven't seen rates like this going back several decades. This picture just illustrates what it's like for the state and for the nation. So We did not see anything like this during the Great Recession. The unemployment rate for the U.S. grew to just shy of 10%, and for the state of California, we were around 12.5%. So, in that regard, this is quite different from the experience we saw in the Great Recession. And I think this is a recurring theme. It's different this time for a number of reasons, and that gives me a fair amount of hope. After we get past the bloodbath that is March, April, May, I think the recovery period is probably going to look a lot better and move a lot more quickly than what we saw during the Great Recession. More on that later. So a little bit more about what's happened over the last couple of months. So job counts in Los Angeles County fell 16%. That's just from February to April. So I'm using February as the marker because that's when we had the last month during which that we could call part of the Great Expansion. Most of you know that we had a record-long expansion underway. It began back in 2009, and it was continuing at a good clip even into 2020. February of 2020 was the month when the recession ended. And of course, it just stopped on a dime. So jobs in Los Angeles County fell 16%, an unprecedented decline from over a 2-month time period. Orange County saw a similar decline. And when you take a look at where the jobs were lost, you can see, if you look at this table, I know it's very busy, but it gives you a sense of where the job losses occurred. Okay, we had about 4.6 million jobs in the Los Angeles County in February. We lost 748,000 of them over the 2-month period, March and April. And about 30% of those job losses occurred in leisure and hospitality. That's essentially restaurant-related declines. We also lost jobs in retail, healthcare, and manufacturing all the way down the line. You can see that we actually lost jobs across every major industry that is shown. But notably, most of the job losses occurred in those top 5. And I think some people were surprised to see that healthcare saw job losses. But let's keep in mind that even as we were ramping up to meet the challenge of treating COVID patients, all sorts of elective procedures and routine medical office visits were canceled, postponed, what have you, by local practitioners during the pandemic shutdown. Now, we saw, I should say, in the the national numbers that came out a week ago, that some of these job counts turned around, and one of the most notable turnarounds was in healthcare. So we would hope that the same will appear here in the local economy as things turn around. But I think, what we need to do then is see, based on this information, where Long Beach is hardest hit. To understand that, we need to know which sectors of the economy are most prominent in, I'm dealing with a little bit of a combined Zoom and PowerPoint challenge. Here we go. Okay, so let's note what the biggest industries are in Long Beach. 60% of Long Beach jobs are in just 5 of these top industries. These red bars show that the largest industry locally by job count is healthcare and social assistance, followed by transportation and warehousing and leisure and hospitality. Then you've got education. If you think about the composition of the local economy, a lot of this makes sense. And so when you're looking at those top industries, and you think back to what we just saw a moment ago, virtually all of these top industries saw major job losses at the county level. So one would expect to have seen similar job losses locally here in Long Beach. So I think that's the first message, that some of the most important segments of our local economy really took it on the chin, just as the county, state, and national job numbers demonstrated had happened at those levels. So a lot of industries, businesses, and households are really feeling the pain right now. Actually, I should probably qualify that, because here we are in approximately the middle of June. And there's a very good chance that by the time we get June labor market numbers, which is going to be about a month from now, we will find that job losses are behind us and will be starting back on the road to recovery. So that is my expectation for the month of June, and recovery, just to foreshadow what I'll be telling you in a little bit. Recovery is likely to be again in earnest in the second half of this year. You can see that over on the left-hand side of this panel, we were growing in terms of GDP. This is a national figure, so we're zooming out for a minute. GDP growth was about 2%, a little bit more than 2% over most of the last few years, a little bit faster than our long-run capacity to grow. You look over at the right-hand side, there's a table that shows on the far right the first quarter of 2020. You can see the hard stop that occurred in terms of GDP, falling 5%. This is an annualized quarter-to-quarter figure. So the real change from the fourth quarter of last year to the first quarter of this year was a little bit more than 1%. When we look at possible estimates of GDP for the second quarter, so the one that we're in right now, we may see that second quarter GDP falls by as much as 40% in an annualized basis, so about 10% from Q1 to Q2. So this is a huge pullback. It's concentrated in the first and second quarters, basically the first half of this year. And then the expectation is that things will begin to improve as we move into the second half of the year. Now, again, this is a different story from the Great Recession. First of all, it's occurred very suddenly. And secondly, there's been a very targeted response of pandemic relief from Congress. So small businesses and households are among the hardest hit at the present time and have been since the beginning of the shutdown. So roughly $1.5 trillion was directed to small business and households over the course of the last few weeks through a variety of allocations and authorizations. So that alone should help to serve as a backstop to the slide in spending that occurs whenever large numbers of people are out of work. And this is an interesting thing. Again, this is a different story from, say, the Great Recession, because in this instance, this pandemic shutdown has been both a demand and a supply-driven phenomenon. Both demand and supply in the economy have essentially stopped. One of the reasons I would point out that we need this pandemic relief is that a large number of households really do not have any savings, don't have the wherewithal, as you see down below, don't even have the wherewithal to meet a $400 emergency expense. So indeed, we can document the fact that many households really have will be having a difficult time and have had a difficult time because of their lack of resources and saving to be able to ride through the present circumstances. So that's the fiscal policy side. On the monetary policy side, the Fed slashed rates, and so you can see that interest rates have fallen as a result. We know that 30-year mortgage rates are at record lows. The 10-year yield remarkably has been below 1%. So there's a lot of liquidity theoretically floating around on the globe and here in the United States. Question is, will lending institutions make it available to households? And what we're finding is that they're being a little bit stingy in that regard. Still, you know, unleashing all of this government support, including a fair amount of government support to corporations and so on, gave a real lift to the financial markets. You can see what the S&P 500 looked like in late February, how it plunged, lost a third of its value by late March, and now is somewhere in the vicinity of 3,000. So there's an expectation on the part of the stock market that the economy will grow at some point. I believe it might be getting a little bit ahead of the real economy, but we do need to keep in mind that the stock market is not a reflection of what's happening on the ground with the economy. with both supply and demand flat, inflation is also flat. So that's something that is worth noting. There are stories that we hear about increases in prices because of shortages, and maybe there will be spot shortages that drive individual commodity or other types of prices up. But the fact of the matter is that under these circumstances, the idea of inflation or runaway inflation is just not a possibility. This is different. The current shutdown is quite different from past recessions. It's worth noting that in past recessions, there usually is a demand side issue, and so imbalances drive some sort of pullback in demand or spending in the economy, and that really has not been the case. It was a deliberate decision to sort of stop the economy, to press the pause button in the interest of getting ahead of the coronavirus and making sure that the number of cases doesn't exceed the capacity of our healthcare system to meet those needs. And we appear to have achieved that, but certainly we're not out of the woods yet. We've got a road ahead of us that we need to go down. And the question is, well, what's that road going to look like? So many of you probably have heard this alphabet soup discussed in the news about what the recovery is going to look like. I don't think we're looking at a W. We might get I don't think we're looking at a V. We might be looking at a W, which is to say that with a flare-up or a second wave, we may actually have a pullback in economic activity a little later on this year. If healthcare restrictions make it difficult to get back to normalcy, then we may see a U shape. But what I'm kind of expecting is best characterized by the Nike swoosh. So we start off gradually and we ramp up over time. We probably expect at least minor, if not more than minor flare-ups to occur in the coming weeks and months. And I don't have a lot of time to go through this, but and we'll share the slides happily. But given the typical way our economy grows, we're adding economic activity, or we did, at a pace of about 2%, which is about $100 billion. So keep that in mind. Okay. Through this pandemic shutdown, we expect to see a pullback in GDP of somewhere in the neighborhood of $1.5 to $2 trillion when all is said and done. So it's going to take us a while to recover, and likely we'll see recovery in late 2021, maybe beyond that. And as far as that timing is concerned, it's more like the recovery that's associated with a typical recession, maybe 6 to 7 quarters. So that's kind of what we see happening in terms of the macroeconomy. There is good news. The number of unemployment insurance claims has fallen from the spike that we saw in late March, so that's good news. This, I think, my last slide on specifics. So in terms of the housing market, home prices have actually not fallen much because the supply hasn't changed, but home sales fell sharply in April, appear to be rebounding some in the month of May. So that's kind of the story there. So our worst episode or time period is this period, March, April, May. We're reopening right now. So much depends on our effectiveness in putting these protocols and other kinds of standards in place, guidelines. Let's face it, we're going to have some flare-ups. We're already seeing the number of cases increase as we reopen the economy. The trick is to keep the number of cases from getting so high that we're worried about bumping up against the capacity of our healthcare system to deal with these things. Bottom line is, this is not the Great Recession. We're going to recover more quickly. There will be less damage. The economy was doing fine on March 16th or March 17th. And there will be some damage to supply chains. We know that some businesses are going to go out of business. But the bottom line is, we think that recovery, which we think is now happening, will gradually accelerate over the next several quarters. Just a final note, we've had in these last few weeks, in response to what's happened in Minneapolis, we've had social unrest in Long Beach and elsewhere across the country. I would just point out that, you know, in a sense, everything that we're experiencing now with COVID, it bears some relationship to what's been the situation historically. We know that there has been a growing disparity in the distribution of income and wealth across all races, but particularly among minorities and African Americans in particular. We know that that this population has been harder hit by the COVID disease and so on. There are any number of indicators that tell us that that the African American community has taken a harder hit, both in terms of the health situation we're facing right now and in terms of the economic situation. So this definitely has to be a part of our discussion of how we're going to recover and step forward. I think based on what I've heard, we may hear more from the DLBA on that topic in some future events. Thank you.
Yeah, thanks, Robert. Yeah, I think you brought up at the end is very poignant in terms of COVID-19 kind of exaggerating or exemplifying some of the existing inequalities that are already in our economy. So I think now we'll move on to Scott Flexo. Great. So Scott, if you want to share your screen for us, you're going to be presenting on Small Business Monitor. So take it away, Scott.
All right. Hello, everyone. Hope everyone can hear me and they can see the screen okay. If not, then you're going to have to let me know because I can't tell.
Looks good.
All right, good. All right. So what I'm going to be reporting on, thank you, Robert. That was really good. Some of that data I've seen before and some of I haven't. So it's really, really, really interesting what you do. It's very, very interesting. What I'm going to do here is kind of take a micro look at this. What's exactly going on with small business in Long Beach and how they responded to how they were affected by the quarantine. And then I'm going to talk a little bit about what business and particularly small businesses can do now that we're opening up to try to grow their businesses again. So that's what I'm going to be talking about today. So let me get to here. So the first part of this is going to be data, and it's based on surveys of small business owners and managers here in Long Beach, something we've been doing now for quite a while, since 2012. This is based on two surveys, one that was done at the beginning of the year and the one that was done in April as we kind of closed down and shut all the businesses down. I want to see what was going on. So that's the data part. Then there's going to be another part, which is my marketing hat, which I'm going to put on. I'm going to talk a little bit about ideas that small businesses can implement in order to try to get customers back into their shops or into their restaurants. Okay, so this is the website for the Small Business Monitor. If you're interested in looking at reports that we have, or if you're interested in looking at the archives going all the way back to 2012, the link is there. If you want more information, you can just email me. I'll be more than happy to answer any of your questions or direct you to the website. All right, so let's start off with what was going on at the beginning of the year. So we take a survey every year of small business owners, and it's a very professional survey done over the phone using a probability sample. And what were some of the results that we had at the beginning of the year? Well, we thought everything was going to be looking great. We asked small business people if they expect their sales to go up in the year and how they're planning for that. And as you can see, in the first quarter, 66% of the small businesses in Long Beach believed and were planning for an increase in their revenue and sales in the coming year. So as you can see, it's a little bit above the prior year. And in fact, it was one of the highest percentages that we were recorded since we've been doing the survey. So everybody was very optimistic as we were heading into 2020. In fact, people were so optimistic, the biggest problem that small businesses said that they were having was finding skilled employees. They were having a devil of a time recruiting people to work because the unemployment rate was so low. Everybody had an opportunity to be able to kind of find the job they want and move from one job to the other. And so small businesses were having a real difficult time with this. And so we were spending a lot of time trying to figure out how they could get in touch with, Pacific Gateway and other kinds of places so that they could get access to employees and to interview and hire them. That's what we were. And then this came along. We had COVID, and March 4th, the stay-at-home orders were issued, and there was a prohibition on events and gatherings, and non-essential businesses and areas had to close. Essential businesses remained open, but not full-time. And so this was a big deal, right? And so we went back out and we asked our same small business owners and managers how things were going. We waited a little bit of time, about a month, and then we went out and we asked to see what was going on. So this is what happened. As you can see in the second quarter, 94% of our small businesses said that they expected a decline in their revenue year over year. So this is just a complete shift from where we saw at the beginning of the year. So nearly every business was going to lose sales. So there was of course, a very bad feeling with many of the people that we talked to about what was going to happen. There was a lot of anxiety about what to do. And that was the state of small business in the April period. Saw them laying people off. 66% of the small businesses in Long Beach reported that they laid off at least one employee. And 70% of the small businesses reduced the hours of at least one employee. So as what Robert was talking about, we see it here just when going out and interviewing small business people about what was happening. They were laying off, they were cutting hours, and it was a very, very significant event. So recently I took a look at some of the data in terms of breaking it out into subgroups that are interesting and important to look at. One of them has to do with the size of the business. So the idea here is it did the stay-at-home orders, how do they affect different types and sizes of businesses? And as you can see here, the biggest impact was on these micro small businesses, those with 4 or fewer employees. 70% of those businesses reported that they have lost sales. In fact, 1 in 4 actually closed, 26%. If we're looking at some of the other small businesses with more employees, the impact wasn't as great, but it was still significant. Half of them had to shed sales, but only 8% actually had to close. So the smaller the business, the more impact this had. And they also have less resources, of course. And because they have less resources, they're not going to be able to maintain their employees. And so, sorry about that. Let me get back to the next slide. So you can see over here, this is the proportion of businesses that reported laying people off and cutting hours. And as you can see, these smaller businesses, the really small businesses, just don't have the resources to maintain a staff without revenue. So they essentially closed up and laid everybody off. In fact, on average, 3 employees were laid off in each business. That was about the average. And if you only have 4 employees, you're laying everybody off. And so that's essentially what happened with these micro small businesses. So they're going to need a lot of help to come back and resurrect themselves as we open up. The businesses that have more employees, they have more resources, of course, so they're able to maintain some of their employees, and so fewer of them laid people off, but still half of them laid at least one person off or cut the hours of at least one. Then we look at areas of Long Beach and see where the impact was greatest. The impact of the COVID stay-at-home orders were greatest in the downtown area of Long Beach. And you can see here that 66% of the businesses in the downtown area said that they were going to lose revenue and were planning on it. And 21% actually closed. We go into the northeast part of the city. That was also significantly impacted. 67% of the businesses there reported were planning on losing revenue or were in the midst of losing revenue, and 36% actually closed. So 1/3 of the businesses in the Northeast actually closed down. In terms of employment, it was in the downtown area where the layoffs were greatest. 77% of the businesses there reported laying off at least one person, and 58% cut the hours. Downtown, a lot of retail shops. We'll talk about that in a minute. That was the type of business that was most impacted. If we come out into the northwest area, we have more manufacturing, more construction jobs, and those were least likely to close. And so we can see the data being reflected there as well, with far fewer businesses being closed than the more industrial areas of the city. All right, and what about the impact on businesses? So the stay-at-home orders had the greatest impact on retail trades. This would be restaurants, bars, shops, small stores, things like that. 71% said that they were going to lose revenue, and 26% actually closed. And you can see the unemployment. Almost all of them had a layoff, at least one person or more, and 2/3 cut the hours of all their employees. So the most significant impact is in restaurants, bars, shops, other retail stores, and getting these kinds of businesses back up and running is going to be the key to returning employment rates back to where they were at the beginning prior to the COVID stay-at-home orders. You can see construction and manufacturing, the smallest impact. They were mainly, a lot of them classified as essential services, things like plumbers, electricians, construction trades, those kinds of things. So they essentially remained open, and but still there was an impact on their businesses as well, but not as significant as certainly the retail trades. All right, so that's a little peek at what happened in Long Beach and where we're at as we begin to open up. So now we're beginning to go through this process of opening up. And so the next question is, where do we kind of go from here? One of the things that we all have to remember about this is, I don't know about you, but I don't think anybody has ever been through anything like this before. So everything that we're doing right now, we're kind of making up, right? We're kind of trying to figure out how to go about the best way of doing this. Everybody has all sorts of different ideas. So I just want to add my thoughts to how a small business might be able to open itself up and begin attracting customers and generating traffic. So I begin with trying to understand what the basic problem is. And the basic problem is perceived risk. This is maybe actual risk, it may be not actual risk. It really doesn't matter. What matters is how much risk the consumer or the customer perceive. And this is what we call physical risk. The idea that you're going to use the product or you're going to use the service and something's going to happen to you. You're going to get sick, or you're going to bring home a virus to people at home and they're going to get sick, and they could die. So this is a pretty significant felt feeling of perceived risk. And so the decision to kind of return to normal and go into a business and stay a little while and interact with the people in the business, for some it's going to be not such a big deal, but for others it's going to be pretty significant. So this is a really unusual situation. And so how does a small business deal with this? How do they deal with this idea of perceived risk and how to increase traffic and then transactions? So the way to look at this is to think about different levels of risk and how risk and the perception of risk affects the decisions that people make. So typically, if somebody is in a low risk situation, that is, the decision they make is going to come with not much impact on their lives. You know, let's say you're going to buy a tube of toothpaste or something. You're not going to need a lot of information in order to help you make that decision. In fact, there's a lot of different rules that people use to make these decisions. We call some of these we call affinity, and some of these we call social proof. These are things like going to Yelp and seeing what other people are thinking about the restaurant, or talking to somebody that you like, or seeing somebody on TV that you like and admire. And you kind of make the decision based on that without spending a lot of time thinking about it, because the risk of a bad decision is pretty low. So in this case, if somebody is not feeling a lot of risk about the situation, then a business owner or employee or customers might be used to provide proof that the business is a safe place to go, that everybody here is having fun, we're all shopping like we used to shop, nothing to worry about, so come on in. And that will be a good approach, especially in the beginning, which I'll talk about in a minute. On the other hand, if there's a very high level of perceived risk, then the consumer is going to need a lot more information before they're going to be able to cross the line and make the decision to use the business. What they're looking for is risk mitigation information. And here the business is going to have to spend some time developing plans of mitigation, of physical risk, of communicating those to the customer at the place of business, as well as in any marketing that they might have. And the goal is to help the customer get the information that they need so they can make an assessment of the risk and the risk probability so that they can then make a decision whether they come in or not. So that's essentially the two kind of approaches to dealing with this idea of perceived risk. So essentially what we're going to have, I believe, in terms of opening up, is we're going to have kind of three segments or groups of people. And the small business owner or the business owner has to understand how to deal with each of these three groups. The first group is going to be the group that has low perceived risk. They're going to be the first ones to return. Their level of feeling about what's going to happen to them is not as strong as some other people. And so they're going to be the first ones in. They're going to be kind of like the early adopters. And most of these people are going to be current customers of the business. They like the business. They like the owners. They like being at the business. And they're going to be persuaded to come in using these heuristics of the business owner reaching out to them and other customers and what other customers like them have to say. And so this is kind of the low-hanging fruit for a business. And so if you have a small business, the first thing you might want to use is your email marketing or your digital marketing platforms, your social media, to reach out to your existing customers and talk to them about a wonderful place you have and how you're open and everything's fine and look what all the customers are saying. And that is going to be a very most effective way to get this first group into your business. The second group, kind of a moderate risk group, these are the people that are going to be next to return. It's going to take a little bit of time for them to come in. They're going to need information. They're going to need risk mitigation information. So here, the business owner is going to have to really think through some of the things they're going to have to do in order to communicate risk mitigation. Signage, hand sanitizers, everybody wearing masks, a recognition by the business that there is this risk out there and that they're taking every precaution necessary to deal with this. This is going to be key to getting what I think is probably the largest group to actually come back and start using these businesses again. So here we can look to, health department for kind of rules and regulations. And this will help a business deal with some of these people who have a higher level of perceived risk and need this kind of risk mitigation information to return. The final group, the high perceived risk group, these are going to be the last people to return. The only way they're going to come back is through performance. So they're going to want to see people going into the business and coming out and not getting COVID. And it's going to take them just a little bit of time. They're going to stay home. They'll probably continue their behavior right now with delivery and takeout if it's a restaurant or shopping online. But eventually they're going to come out. They're going to have to. But it's going to be a slow kind of churn with this group. I don't know how large this group is, who they are. I haven't done any research on that, but certainly there is a group out there. It's going to take a little bit of time for them to come back. So you got to perform. You can't have any mistakes in this because, if you do, that's going to increase the perceived risk again, and that's going to be problematic. So I see a lot of businesses as we move forward here kind of competing a little bit in this area to try to show that they are doing the best job they can in dealing with this. And other competitors, you don't want to say your competitors aren't, but the idea is that you're really trying to help customers manage this risk and understand what the probability is so the customer can make a decision whether they want to come in or not. And those are some data, my ideas on opening up Long Beach. And I want to thank you very much.
Great. Thanks, Scott. Okay, so let me just share over here back to my screen, and I'll just get to quickly get to some big questions here, and then we'll have time for just about one more audience question. So you guys got to this initially in your presentations, but really what makes the COVID-19 recession right now different from past economic downturns, particularly the Great Recession? So yeah, I'd like to hear from both of you on this one.
Okay, shall I start?
Yeah.
Okay. So not only am I going to draw a quick comparison of the COVID recession with the Great Recession, but also the Great Depression, because we've heard comparisons with this, especially, people are thinking back, you had the 1918 Spanish influenza, which was the last pandemic that was of this sort of magnitude. So people are thinking back through history. So let's just set the record straight. First of all, we're lucky we're dealing with this in the 21st century and not in the early 20th century. Second, the COVID recession or contraction is quite different from both the Great Depression and the Great Recession, primarily in its origins. Second, and that's because the economy was doing fine leading up to this point. So much of the economy is still intact. We may have had to push the pause button. There are some sectors of the economy, as you saw, that were very hard hit, notably restaurants and retail, healthcare. Healthcare at the national level already restored about 25% of the jobs that were lost during the period March through April. It was a very severe surge in unemployment and a very sharp pullback in employment that we've seen, as well as other measures of economic activity. It will take time to recover, but I think the first thing to note is that we're going to see a recovery that's more like a typical recession, not as harsh as what we saw during the Great Recession. Remember the collateral damage of the Great Recession. There was a financial crisis that gave rise to a whole lot of people going into foreclosure. So not only did people lose jobs, but homeowners lost their homes. Home prices around the state fell by upwards of even 80%, believe it or not. That sort of pain is very unlikely under these circumstances. Yeah, we'll see some deterioration in the housing market with higher default rates and so on. But an awful lot of backstops have been put in place. I mentioned the what was the 3 some million trillion dollar package that was passed by the Congress. Mortgage lenders have offered forbearance. In fact, the state has required that. We've got a number of efforts underway that are trying to soften the blow all the way around, and hopefully we'll be able to deal with this a lot more effectively than we did during the Great Recession. So I'll just leave it at that. This is quite different.
Mm-hmm. Scott, is there anything from the consumer standpoint specifically, maybe for Long Beach as well, in terms of how they've reacted?
Well, I think that I think overall, what this has done is kind of accelerated existing trends that were already prevalent and that we've been talking about for a while. But now this was such a sudden shock to the system that it has accelerated these things. One of the things that has accelerated is the move from a standalone bricks and mortar business to kind of a online marketing or a combination online and bricks and mortar experience. And that's the way consumers have been moving, relatively slowly, but surely. And businesses that were not able to adapt to this had some time to be able to learn how to do it, but we don't have the time now, so it's over. And so a business really has to quickly and as efficiently as possible shift their activities, their marketing activities, especially so that they can leverage technology and information to run their business. And I think that that's something that is going to have to happen if a small business certainly is going to want to stay in business. So I think that's one of the big differences that we have.
That kind of answered the next question, but that's
Sorry
perfect.
About that.
No, that's good segue. Yeah, so combined with the ability to exist in the digital space and then also identifying that gap that a lot of people have if you are, whatever it is, cash only, you don't have good internet access, you're not able to move on to e-commerce. That kind of brings up some interesting equity issues as well. But it seems like a lot of the trends that were already happening have kind of the competitive advantage has kind of been exaggerated by this crisis. And so, but those trends were already there. I want to get to one more question before I do some audience Q&A, but I want to ask you guys, like, what have we learned from the COVID-19 recession? What is a takeaway going forwards when there's inevitably another economic downturn or pandemic? What can we use from this current situation to apply to that future crisis?
You want to go first, Scott?
No, you can go ahead, Robert. You're okay. Better on this. Go ahead.
Well, okay. So I'm going to go back for a second to the earlier question about technology. And Scott made some very good points. In many ways, some of the things that we have had to do in the last several weeks were already underway. It's just that COVID and the shutdown accelerated those efforts. If we look back at the Great Recession, one of the things I should point out is that in areas where there were opportunities to automate, automation accelerated during the years, let's say 2009 through about 2012 or 13. I'm thinking specifically about manufacturing, but elsewhere. We also have seen a long-term trend in office where office workers have been increasingly working remote. Well, this situation just accelerated that. And it also meant that we were looking at smaller footprints, if you will, for the typical office worker. That might change with COVID-19. They may need more space, at least for the time being. So that's kind of thrown that long-term trend into disarray. So there are any number of areas where we are probably going to see permanent changes, but I do think that we're not going to all decide that we're so in love with Zoom that we're wanting to continue this for the rest of our working lives. I think we all appreciate face-to-face interaction and so on. That's probably something we have learned from the COVID recession, is that much as this technology can enable us to keep the lights on even during difficult times and having to take extreme measures, that it is a substitute, but not a perfect substitute. one point I think is very important for us to keep in mind is at the local level, cities and counties, even state level government doesn't really think about strategically dealing with an economic downturn. But in this particular downturn, they have been forced to do so. And so I think that we really need to spend more time thinking at the local level, at the city and county level in particular, about developing plans, strategic plans for what's called economic resiliency, that will allow us to sort of prioritize responses as we move through the worst days of a downturn, and then come out of those worst days and move on to recovery, because the responses that are warranted differ depending on what stage we're in a downturn, a recovery, and expansion. Which economic or policy levers need to be pressed, which are the best times to press them. So I'll leave it at that.
Thank you.
Oh, no, I'm good. We can move on. That was a good answer.
Okay. Yeah, great. Yeah, so one more. I'll get to two audience Q&As here. So first one I had, how do you expect the added public debt at the state and local level to affect the recovery?
Robert, that's your question there.
I apologize. I was looking at the chat. There was a question that popped up about businesses opening and the increase in the COVID cases. What was your question? I apologize.
This one, how do you expect the added public debt at the state and local level to affect the recovery?
Okay. So we don't have a lot of time to talk about a very large question. So indeed, we're looking at $3 trillion in additional debt at the national level, plus the state of California burned through its reserve fund, its rainy day fund, and is looking at budget deficits again, even at the local level. So these next couple of fiscal years are going to be exceedingly difficult mainly for state and local government, because they don't have the power to issue debt. So it's arguably some of the responses that government may want to engage in, they're going to be constrained to do so if they can't afford to pay for it. So those instances, identifying those areas where there's a need but not resources at the state or local level, one would hope that the federal government would be able to step in and provide funding. We're all worried about national debt and about the high budget deficit that now already exceeded $1 trillion before. Thankfully, interest rates are very low, so we can service this debt as large as it is. And so that's good. We shouldn't be worrying about this problem right now. This was a problem we should have been tackling when the economy was expanding. But in the Washington, D.C., neither the Democrats nor the Republicans saw fit to do so. So we really need to lay the blame on all of our policymakers there for where we were before we even got into spending money on the pandemic relief. I mean, there's so many other things. Keep in mind that if things go south, okay, there's no guarantee. Everything is dictated by how the virus fares, how the disease fares over the next few months. If things go south and recovery is not as rapid as we would like, then the Congress may have to consider some type of economic stimulus on top of this. So final note is that we often worry about how much of our debt is held by foreigners, by China and so on. Please keep in mind that maybe 2/3 or more of our debt at the national level is held by Americans. So Americans the US government is basically borrowing from Americans, and then those interest payments are going to go back to those Americans, to their households, that they can in turn keep within the US economy. So a lot of information there in a very short amount of time, but that's kind of the lay of the land.
Gotcha. And so I'll just get to this one last question, and this kind of relates to what you were talking about, Scott, about risk. So businesses are opening up now, and we're also seeing an increase in coronavirus numbers as well. So at what point will businesses, be told that they have to shut down again? Or do you think that's a possibility as well, and kind of restarting that whole process of perceived risk?
That's a really good question. So as a business owner myself, and as a consultant to businesses and a teacher and stuff, the thing that I tell people is that there's only certain things that you can manage and control out there in the environment, and certain things that you can't.
Mhm.
And one of the things that a business owner cannot control is the extent of COVID-19 and how it's going to spread in the community. That's not something that we can manage. The only thing that we can manage is what we have. And so what we can manage is our business and how we interact with and respond to our customers. So in that regard, the old adage, plan for the worst, hope for the best, is probably the best approach to this, and not think and worry so much about what's going to happen with COVID. So the recommendation is to be very close to your customers in terms of, especially those who perceive a little bit lower risk related to this, because they're going to be the early adopters and the ones that are going to be the first into your store, or shop, or business. And use your tools of the new tools of social media and digital marketing and email marketing to constantly reach out to them, and then try to do the best you can at your store or online or whatever it is that you have, to talk about how you recognize risk and how you're trying to manage and mitigate it according to what the authorities are telling you to do. And that's about all you can do. And hopefully things are going to work out. We can be optimistic, but again, plan for the worst, hope for the best. That's about all you can do as a business owner.
I think that kind of relates as well to what Robert was talking about in terms of future economic resiliency plans. So having something in place when there's an inevitable downturn as well. So that's really interesting. And as I said before, guys, I'll be emailing these slides out to all of the participants following this, so you guys can have something to look onto. But these are some really helpful insights at the national level, and then I think what's unique here is specifically getting into Long Beach. Some good ideas to consider going forward. So I want to thank Scott Flexo and Robert Kleinhenz for joining us today. A lot of information in a short period of time, but I appreciate you taking the time out of your day to help inform us. So thank you very much.
My pleasure. Thank you, Mo.
Yeah.
Thank you, everyone.
And a quick programming note, we had a webinar that was planned last Friday that we were postponed as it related to office space, which actually came up in this conversation. So that has been moved to 2 Fridays from now, on June 26th at the same time, same Zoom link as this meeting as well. And so that'll be going over the work from home migration and the future of office space, just as a programming note. And other than that, yeah, the DLBA has some more things in store as it relates to webinars, going into some other topics beyond coronavirus and specifically economic development. So we're really excited for that. But I want to thank everyone for joining. And again, thank you to Robert Kleinhenz and Scott Flexo for providing us with this information. So I'll end the meeting now, but thank you everyone for joining us. And I hope to see you 2 Fridays from now on the office webinar. So thank you guys.